Welcome to the August webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined as always with Bob Paolucci, our founder and CEO. Bob, hello.
Good morning.
Good morning. Happy summer.
Happy
And
August.
yeah, so the title of our webinar this month is summer recess. And I think there's a couple of reasons that we decided to title it this way. One is, school is taking a break, of course. The markets are also taking a breather. But I think the second connotation is that the Fed is also taking a recess in what they call their visit to Jackson Hole. Is that correct?
That's correct. Yeah, so the government goes on summer recess. The market takes a break, usually in August into September, and the Fed has a meeting in August. It's at the Jackson Hole, Wyoming venue that they use every year. So they're also on summer recess. So what a great time to use the phrase summer recess.
Yep, absolutely. And what we'll do today is follow the cadence that we have in the past webinars, where we're going to break out the presentation into the markets, economy and policy, and then our everything else section. So let's kick off the presentation with the reversal that we've seen in the market so far this year. We hit a market high on February 19th, where we then proceeded to see a drop of 21%. We hit the low of April 7th with anxiety at an all-time high. And on that day, Principal Wealth did buy for our clients. And since then, we've now seen a reversal that's up 32%, excuse me. That anxiety is calmed. And now we're at this all-time high that everyone's questioning, where do we go from here?
Yeah, we went from all-time high early in the year to well below an all-time high. So really on the verge of a bear market.
Mhm.
We hit it on an intraday basis, but didn't close there, so it doesn't count. We invested uh, heavily down at the bottom on April 7th. And yeah, we're back up to new all-time highs. How quickly that turnaround can happen. And it's also a good reminder that you just have to really stay invested in good stuff. Markets go down for reasons that are far beyond fundamentals. For this one here, it was the uncertainty around trade, the way it was articulated or not articulated, and sort of the fear of the unknown, right? So
Yes.
there was money in motion. Most of that was due to computers trading very quickly. Most of it was pre-market and aftermarket moves anyways. But here we are, as if nothing happened other than the market climbing, and we're setting the stage for more all-time highs. The fundamental backdrop is solid. There's a lot more certainty than there was 3 months ago, 4 months ago, and you have a scenario where it's very likely the Fed will be cutting rates in September, and will likely not stop cutting them for the next 2 years. So we continue to believe that the setup is going to work well for volatile assets, for risk assets, aka stocks, which is very exciting for us.
No, absolutely. And we have some great reasons in this presentation for the continued all-time highs. However, we do want to also manage expectations where we may be entering a little bit of weakness, which has traditionally happened at this point in the year.
Summer recess.
Yeah.
Yeah, we titled it for a reason. So August is historically one of the worst months in the market, usually due to the fact that Wall Street goes on vacation and those machines are turned down a bit
Yeah.
that trade daily. So what does that mean? Well, in turn, there's less volume, therefore less activity in the market. So you could chart out volatility in the S&P 500, the buying and selling of shares, and you'll always see a lot less volume, usually mid-July through the first 2 weeks of September. And then September, everyone comes back, the machines get cranked up a little bit. There tends to be some year-end planning that happens, right around the end of the third quarter into the fourth quarter, and that's when you see volume pick up, and that's when you see usually at the end of the year, it ends usually with a good quarter.
Yeah.
But there is some choppiness to be expected
Yeah.
right around now, and you can see. more closely here, this is looking at August in particular.
Yeah.
August, if you get a positive August, you're lucky. It's not supposed to happen that way. There are usually no big events. Also, keep in mind summer recess, government's on vacation, so you don't have a lot of government intervention. You don't have a lot of really anything going on
Mhm.
other than the buying of lobster rolls and French fries, usually at the beach.
Yeah. And so I think also, despite some of this summer recess that historically occurs, we have a lot of reasons for optimism, and we would start talking about, the forward earnings expectations when you look on the left of this slide continues to rise.
Yeah.
When you look on the right-hand side, profit margins continue to expand and are expected to over the next 12 months.
Yeah, and earnings are rising, so the market moves in the direction of earnings, and you can see the direction of earnings quite clearly on that chart on the left.
Mhm.
If earnings move down and they move down consistently, the markets will move down. But earnings tend to, when there's a bad year in earnings, it's usually washed out over 3 quarters. Businesses find a way, whether it be cutting expenses or focusing on new products or efficiencies, or in some cases raising prices, changing, leadership, they figure it out pretty quickly.
Mhm.
And that is usually the major foundational element to corporations having stock price increases, right? They
Yeah.
run a good business, they figure it out, they can weather storms. And if they have a blip, they usually come out of it pretty quickly, at least good companies. On the right, profit margins. So the net earnings of companies, right? Or the net profit margin, how much they actually capture,
Mhm.
continues to rise as well. We're at all-time high profit margins. So, I think there's some wiggle room up from here, mostly due to the positive benefits of AI and efficiencies. But I don't expect profit margins to continue to rise much higher than maybe the 14.5% level, because we are at historic highs on profit margins,
Sure.
right? So then you make more earnings by more volume,
Okay.
right? So if you have
Yeah.
that profit margin, you just have to do more stuff to create better earnings within that margin, if that makes
Correct.
sense. Yep.
Absolutely. And I think another reason of optimism is looking at business spending, and this in particular is focused on AI in regards to CapEx.
Yeah. So with profit margins at an all-time high, spend more money, spend some of that profit margin to create more efficiency, which creates over time a bigger profit margin. So here's one slice of a subsegment of where businesses are spending money. It's pretty substantial, though. It's spending on artificial intelligence, because what it's starting to show is you spend money on artificial intelligence, it is creating a tremendous wave of efficiency. And the chart on the left shows just a shocking sum of money being spent and projected to be spent on artificial intelligence.
Mhm.
So CapEx, government term, is capital expenditures. We're looking at, business CapEx here, and we are expecting businesses to spend lots of money, and that is good for the economy. That is good for the markets. Especially when it results in productivity gains and higher earnings.
And Bob, when you say businesses spending money, we're talking about how businesses are acquiring or upgrading, maintaining their physical assets,
That
which is long term.
services, technology, planning for the future, locations. With the passage of the most recent bill, the big beautiful bill,
Mhm.
there are depreciation rules. If you're buying tractors and heavy vehicles and machinery and you're building stuff, there's going to be a lot of capex coming, which means market should do well, economy should do quite well.
Yeah, great. And on top of these businesses planning longer term and spending, there is a ton of money in motion right now.
Yeah, so Juliana, people are starting to pick up on some of the conversations around trade that Scott Bessent, head of the Treasury, is having, the president's having. They are talking about tariff rates and trade deficits. And what you're seeing is the countries that have the lower tariff rates have agreed to spend money in the US, right? There's a direct correlation.
Yeah.
If you smile, if you're nice, and you lead with, we're willing to spend a lot of money in your country, your tariff rate seems to be much lower than some of the others,
Mm,
right?
yeah.
And here is a very short term blip up in the impact of that. And what you see here is there's a lot more US capital inflows that are coming in very quickly.
Hmm.
You could see it on that chart. It's just a straight up arc.
Yeah.
And I believe if we check this again in 6 months, that line will be way higher,
Okay.
way higher.
Yeah.
And that money is to not only come here, it's to be deployed in business building activities based in the US.
Right.
So something to be mindful of, and it's something that we will be watching. That's a good thing.
It's a good thing. Yeah. And so, we've highlighted a few good things. And the last slide we have as it pertains to the markets, I think is such a reminder. It's an oldie but goodie in terms of talking about, you have to tolerate volatility and you need time to get the good results that we're all looking for.
Yeah, I mean, our first slide covered the wild all-time high in February, 20-ish% correction down to April 7th, and then a wild 30% rise up from there.
Hmm.
Um, it's imagine people jumping out of the market in April,
Yeah.
right?
Hmm.
And not getting back in. You missed a 30+% ride in the market. So you really have to understand, if you're going to go out there surfing, you have to understand that there are big waves, there are small waves, and a lot can happen,
Yeah.
right? So before you go surfing, you have to have a basic understanding of what happens,
Hmm.
right? And if you do, your expectations are set properly. So when you fail, short term, when you're surfing, you
Hmm.
get back up, you get on the board, and you'll figure it out. Same thing when you're investing.
Yes.
You have to understand that volatility is normal, and the reward for tolerating volatility over time is good returns.
Yeah.
It's super simple. So it's always helpful to remember that the market will likely experience about 5% pullbacks per year. Excuse me. You should expect one correction of about 10% per year, one correction of around 15% every 3 years, and a correction of about 20% roughly every 5 years.
Every 5 years.
Every 5 years. And the reward for that is about an 11% annual return on stocks
Hmm.
since 1950.
Yeah.
Yeah. Well, if you want that, you have to tolerate what's on the left-hand side.
Yeah. And if I could also add, we talk about this all the time. The largest attributions of these corrections are not necessarily anything fundamental in the market. It's more of an emotional reaction.
Usually overreaction.
Yes,
Yep.
exactly.
Yep.
So no, I think that's a good way to end the markets section of this
Mhm.
webinar, and let's move on to the um, economy and policy and start with the Fed meeting as it pertains to their last July meeting.
Yeah. Yeah. So there's a lot of weight now on the Fed, a lot of eyes on the Fed. There's been a resignation or a retirement, I should say, of one of the voting members. There will likely be a retirement of Jerome Powell that is coming early next year. And what we have here from the July meeting is a Fed that is really getting ready to do something. That's how I'll explain it.
Mhm.
They weren't ready in July because they didn't want to do it in July, but they are getting ready to do something, which will likely be articulated this month in August at their vacation meeting and then executed upon in September. They addressed a lot in their last press conference. Number one, that they understand that high short term rates, the things that they control, are restrictive. They're moderately restrictive, which means the economy is functioning well even with these high short-term rates. They address the fact that inflation, both measurements of it are in the twos, which is
Mhm.
great. They address the fact that tariffs will likely be short-lived with any impact on inflation, and they were starting to refer to it as a one-time shift, right? Because if prices with tariffs are adjusted because of tariffs, they'll be adjusted once.
And Bob, how many times did they reference that in their meeting? Because I know you counted.
So they finally admitted that, so much so that they mentioned it. This is Jerome Powell in his press conference that came after the written statement on July 30th. He mentioned it 7 times in the post meeting press
Post.
conference.
Yep.
Yeah, one time shift, one time shift. So it's almost like he's downplaying any potential inflation from tariffs.
Hmm.
And if he's downplaying it and not using it as a barrier anymore, you have to understand this, nuanced language he's using. He's sort of just pushing it aside to say, all right, now on with the mission.
Right.
And I think that's exactly what's going to happen in September. Let's stop worrying about tariffs and start doing something now.
Yes.
So we firmly believe that the Fed will cut rates, and they likely won't stop for some time.
Mhm.
We in-house think that there will be 3 or 4 cuts before the end of the year, which ironically would mimic last year. They
Yep.
started in September, ended in December. We think the cadence will look very similar. And we even think next year they probably have 3 to 4 cuts in store as well. They may do them quarterly.
Okay.
Yeah.
Yeah.
So we shall see. So here's sort of where things stand as of 7:30, but something did happen that same week. So they met on a Wednesday, and on Friday something happened, but we'll get into that in a second.
Yeah.
What you did see with this meeting, I do want to talk about this, is you had two dissents. So two voting members disagreed with the board, and the last time that happened was December of 1993, right? So you had two dissents. Two voting members said, "Hey, I think you should cut rates. I don't think we should hold tight here."
Amazing.
Hey, good for them for speaking up. We put a quote in here: if everyone is thinking alike, then no one is thinking, from Ben Franklin, right?
Yeah.
So don't you have boards and committees to have differing views and opinions?
Absolutely.
Isn't diversity of opinion a good thing, right? So we haven't had anyone really speak up in 30 years,
Since I graduated high school.
40 years, right? I mean, come on. If you're part of this committee, you're
It's
just
really,
agreeing with what's happening.
yeah.
Look at the amount of agreeability that has happened since 1993
Yeah.
up until now,
Yeah. With
right?
some
It's okay to
really,
disagree.
really directional pendulum swings
Yeah,
along the way. Yeah.
yeah. So if we don't like policy, well, maybe we should change the people on the board so there's a little bit more due diligence
Hmm.
and testing and taking the other side, right? That's how
Yep.
you have good debate. That's how you get it right.
Yeah.
So one would say if policy was wrong for the past 20 years, it's because no one spoke up over the past 20 years.
Yeah.
It's rare. So hopefully with future feds, there's a group of people that take the other side. I mean, even just to take the other side.
Yeah.
Sometimes you don't have to believe in it. Just take the other side. You
Yeah.
might learn something from that.
Absolutely.
So, two dissents made the news. It's like, I feel like no dissents should make the news. But, anyways,
Yep. Well, and in talking about the Fed, let's talk about the interest rates and the views of others.
yeah. So, look, we're sharing our views. Here's the view of Goldman Sachs. Take it with a grain of salt because they change their mind every 2 hours. But they agree. They're of the view that, yes, the Fed will cut at every possible opportunity for the rest of the year.
Hmm.
And the opportunities start technically in September. And they have them cutting next year with the terminal rate ending in essence right around 3%. Yeah, well, that's easy. That's what the Fed said they were going to end at. So, but here's the opinion of Goldman Sachs. If you care, we really don't, but it's nice to put someone else's opinion up on the board.
Absolutely.
Yeah.
And another topic that really made the media is this jobs revision.
Oh, you don't say. So this also made the news. The Fed meets on Wednesday, July 30th to talk about the fact that we're near full employment. The jobs picture is pretty steady. Inflation remains low. Tariffs, if there are any inflation, will have a one-time effect, so on and so forth.
Mhm.
And then 48 hours later, we have the single biggest revision to the jobs number, to the 2 month rolling jobs number ever.
Yeah.
So, it's a big deal. Sorry, outside of COVID. But COVID, you got to get people to respond to these surveys. There was other things going on in COVID. So the only other outlier events here in a negative way were COVID,
Mhm.
right? So prior to COVID, this was the biggest revision in a 2 month period of time in history,
Right.
right? At least in a negative way. So that's why it was a big deal in the news. And, that's why you could see, some rationale behind the president firing the person who is in charge of, you know, overseeing the accumulation of the data that gets put out.
Right.
Last year, there was a larger revision, yes, of 811,000 jobs right around the same time last year, but that was from a year to date standpoint. So that was 8 months of data being revised.
Right.
This was
May and
two.
June.
This was May and June, two
Right.
months of data. This was pretty significant. So, so significant that it moved the unemployment rate up from 4% to 4.25%.
Mhm.
So, had the Fed known this, I think that meeting would have turned out a little differently.
Okay.
Which is why the odds, according to the Chicago Mercantile Exchange, of a cut to interest rates in September are now about 90%.
Okay. And you look at these revisions and you have them, you always have them over time, and you have these justifications that they're seasonal adjustments. You have weakness across sectors, and in particular government, from everything that transpired this year. But there was one other reason that you wanted to touch on.
Yeah. So I've been super critical of the Fed relying on data, right? Because the data that they rely on, and you've heard us talk about this, is stale. It's backwards looking,
Mhm.
right? The
And
you
we
want to
talk a lot about that with inflation,
We
correct?
talk a lot about that with inflation,
Yep.
amongst other things. We also know that the employment data is flawed, especially when you have to rely on surveys and people and businesses responding, right? They could be in a bad mood, they could be on vacation, right? So then what's important? Well, participation rate,
Hmm.
right? Answer rate, actually answering the questions that are asked. What you see here is over the past, I don't know, decade or so, there has been a major decline in the response rate of the data.
Yeah.
So why would you depend so much on stale data
Hmm.
if it's even weaker data?
Yeah.
So stale, weaker data, I don't know that I would rely on any data as heavily as the Fed is to make critical decisions.
Yeah.
The prior Feds, so the prior Fed regimes, by Janet Yellen, and prior to her was Ben Bernanke, they were forward looking. It's actually a thing, right? They actually referred to it as forward looking guidance,
Hmm.
which meant, yes, we look at the data, but that doesn't do anything
Determine the
for us.
decision.
Yeah,
Yeah.
it doesn't sway us. We want to look forward. We
Correct.
want to we want to see what the new trend is,
Hmm.
right? To help make our decision, because
Yeah.
we don't want to be late. We want to get it right, so on and so forth. This Fed uses backwards looking data that happens to be quite weak data
Hmm.
because the participation and response rate is significantly lower than it has been.
Yeah.
So, when a lot of people are saying, hey, the Fed is just sort of out of touch, out of tune. They're talking about stuff that doesn't make a lot of sense in the real economy. Yeah, because they're relying heavily on this stale data with a low response rate. So articulating why we've been critical, I think you can kind of see it clearly now.
And speaking of stale data, let's talk about inflation.
Wow, look at you, Julina.
I know.
That was a backhand slap to someone. It wasn't us, of course, but
That usually comes from you. Everyone's
that was
surprised
very
it's coming from
smooth of
me.
you. Thank you for that. See, wow, you're really good.
Yeah.
So anyways, our two measures of inflation, headline and core PCE, again in the twos, and they'll be
Mhm.
there for some time.
Despite tariffs.
Right.
Let's talk about tariffs.
Right. So tariffs really haven't shown up anywhere in inflation. And I can talk briefly about that. Part of it is because if you're exporting goods, right, because where are you going to see inflation? Exporting goods. So it's the
Correct.
consumption of goods here that came from overseas. Well, number one, the exporters have received a positive bump in currency. Their currencies have strengthened versus the US dollar, number one. Number two, they don't want to lose wallet share to the largest consumer on the planet, which is the United States, right? From a dollar standpoint. China and India being the largest number of consumers, but US has fewer consumers, but we consume a ton. So you don't want to lose wallet share to the US. So what happens? Well, the exporters of stuff take it on the chin.
Hmm.
That's why there is no increase in inflation. Period. End of story. The exporters don't, even though they know there's going to be a cost adjustment when it gets here,
Yeah.
they will adjust cost on their side, which is why you don't see wholesale prices rising, right?
Overall.
There's a reason for this. Yep. So PPI, which nobody seems to pay attention to, is incredibly low. Number one. Number two, those businesses overseas and the exporters of goods have made maybe a little bit more profit net of a price decrease. Why? Because of the currency exposure that they have, number one, and the unwillingness to lose market share, wallet share to any other competing countries. Does that
Okay.
make sense?
Yeah,
Yeah.
absolutely.
The flip side to tariffs, so the money collection side, has resulted in a heck of a lot more money coming into the US government. Let's call it a tax, maybe not a tariff, a tax on goods, foreign goods.
The
And
jump.
this will keep coming.
Hmm.
This will keep coming. So it will keep coming until I guess the president says otherwise at this point.
Right. More revenue is good. Another way to maybe look at tariffs is looking at some of the adjustments here.
Yeah, countries sorted by largest trading partner to smallest. There's too many to list. And honestly, we probably should have stopped at the UK because anyone below that line is really, we're talking 1 or 2% uh, uh, sums of exported goods to the US. So in Europe, really, individually, those countries don't mean much, but glued together, they end up being the largest trading partner, followed by Mexico, then Canada, then China. How about that? So this is sort of a chart of just where the tariff rates stand.
Hmm.
And you got some at 10, you got most at 15, and a few above that. I know Switzerland is trying to get their tariff rate down, mostly because they sell a lot of watches here. Myself being a watch collector, I hope Switzerland does negotiate it down to zero. So we shall see.
One more slide on tariffs in regards to where the inflation rate is.
Yeah, this slide is courtesy of Kyle, who just wants to beat this topic over the head with a sledgehammer. Where is the inflation? Tariffs. And again, just a chart that shows US import price index in June was negative.
Right.
Let's repeat that, negative.
Yeah.
And if you exclude petroleum, it's still low. It's right around, less than 1.5. So again, stuff that's coming over. This is the index. Where's the inflation?
Right.
We don't see it.
Yeah. And I think this is important because it's really easy to hone in on one key area in regards to the effect of tariffs on inflation, and then
Yeah,
to imagine that spread across all sectors and all goods and services. And that's just not the case.
that's right.
So I guess now talking about low inflation and the potential of cutting rates going forward, let's talk about mortgage rates.
Yeah, probably um, the area that is most negatively impacted from high rates is going to be housing, and that shows up through record levels of unaffordability, right? And look, in absolute terms, if you're, I don't know, 40 years old or older, 6.5% mortgage rates isn't high. If you're 80 years old and older, 6.5% mortgage rates sounds low. If you're 25 years old or 30 years old, 6.5% mortgage rates is ridiculously high,
Right.
right?
Yeah.
Um, yeah, because we're coming out of a 20-year period where overnight interest rates were zero or near zero, and mortgage rates were in the twos and threes. Well, those days are gone,
Hmm.
and we probably won't see them anytime soon, but we will see probably fours and fives soon enough.
Yes.
Uh, thank God, because it is high mortgage rates are creating a little bit of havoc in the housing environment. Number one, it's it's allowing rents to stay high. Why? Because there aren't a lot of competing listings for people to buy
Mhm.
to get out of those rentals. And if there are more listings, you got to finance it at a significantly higher cost now. That makes sense?
Yes.
Right. So the chart on the left shows about 71% of all outstanding mortgages are under 5%. I'd like to add the next category up to 6%. There's about now 80% of all mortgages have a mortgage of less than 6%. So to me, that says the activity level to unlock housing is going to be somewhere in the fives. You will see a heck of a lot more activity, more listings, more transactions, closings, so on and so forth, with the 30-year fixed rate in the fives.
Yeah.
And that is certainly going to be on the horizon. I think that the government could even work on a um, mortgage program to help create more supply in the
Okay.
housing environment.
Yeah.
Yeah, I wouldn't put it past this government to actually buy down longer term rates using their own money to, I guess I should say it this way, manipulate the yield curve so longer rates come down, which could create immediately lower mortgage rates, lower car loan rates. Those are the big ticket items that benefit the economy significantly in this country.
Right.
So, I guess I could even say that it's in our best interest to do something like that.
And we've done that before.
We've done that before.
Yep. And speaking of the government, we now have this big, beautiful bill. There was a lot in it. And I know you wanted to address one of those key items.
Yeah, one of the items, just to mention it to everybody, is there's one provision called no tax on car loan interest. It's a little deceiving, but directionally accurate.
Mhm.
You can deduct up to $10,000 worth, or you have a maximum annual deduction of $10,000, where you can deduct interest associated with buying a car, or I'm just going to call it really any vehicle, as defined in this yellow box as just about any vehicle that weighs less than 14,000 pounds, which is just about any vehicle minus a Mack truck, which would be for commercial purposes. As long as the final assembly was in the United States.
And how do you know that?
There is a VIN decoder website listed in the fine text at the bottom of this slide where you can go and you can type in the VIN number of the vehicle you're looking to purchase and it'll tell you where final assembly was. So if most of the vehicle was assembled in Ireland and then quote unquote final assembly was in the United States, it qualifies.
Okay. Yep.
So I think people were initially thinking it was going to be, you know, some Kias and some Fords and some GMs that were made in the US. It's
Right.
not. It's as long as the final assembly was in the United States, you have the ability to deduct some interest
Mhm.
subject to modified gross income limits as always. But
Correct.
if you make right around $200,000 of joint adjusted gross income, you may qualify to deduct the finance charge on that vehicle that you buy.
Interesting.
How about that?
How about that?
Yeah.
Yeah. I think that'll
So
benefit a lot of
if
people.
and now if you're a client of ours, you probably don't finance anything, but your kids do and your grandkids do. So make sure you mention it to them, or better yet, refer them to us and we'll mention it to them.
Yeah, absolutely. Let's transition now to the last section, which we have defined as everything else, and start with the discussion around stablecoin as it relates to the treasury market.
Yeah, so we had some cryptocurrency regulation kind of roll out over the past 3 months. And one of the things that passed was regulation for stablecoins. What's a stablecoin? Here's the best way for me to explain it to you. It is the money market world of cryptocurrency. So when you sell your cryptocurrency or you convert your cryptocurrency into, let's call it cash, it's usually stablecoin, right? So it's the money markets of cryptocurrency. So in the banking world, in the non-cryptocurrency world, which is most of the world, you have an asset. Let's say you sell it, it goes into a money market,
Yeah.
right? Those money markets have to be invested in guaranteed securities. Those guaranteed securities are treasury bills, right? Treasury bills, treasury bonds, US government guaranteed securities. It's the only thing that you can say is guaranteed according to all the regulators and the SEC, so on and so forth. So, and there's banking regulations that get involved and all that fun stuff. So take the same banking regulation concepts and move it over to the cryptocurrency world. And now you have stable coins, which are money markets for cryptocurrency, are now regulated and allowed. They just have to have backing collateral, which is guaranteed investments, which are in English treasury bills. So the government, through creating regulation for cryptocurrency, just created an enormous buyer of US treasuries.
Correct.
And we mention this because you hear stories about China and other countries kind of pulling away from our treasury market,
A lot of concern there.
buying fewer dollars of ours.
Right.
We're about to replace it with what could be the biggest buyer of our treasury bonds in history.
Mm-hmm.
As cryptocurrency grows, it's already good size now. The cash sweep account, money market accounts of cryptocurrency are forced to buy US treasuries.
Mm-hmm.
So I believe the replacement strategy for US treasury buying may be better than the old buyers.
Mm-hmm.
So something to be mindful of. We'll show you this on the next slide. Yeah, so in red, you have the current level of treasury holdings by stablecoins, and that's about to rise rapidly. And these are foreign holders. And by foreign holders, the term really just means minus us in the
Mm-hmm.
United States, right? So there's already $150 billion of treasuries held by these stablecoins. Trust me when I tell you that's about to skyrocket. And as it does, that will be putting a cap on rates,
Mm-hmm.
right?
Yeah.
So now what's critical is what maturities do they buy? Do they buy short term? Do they layer it out with excess reserves? We're going to see. But if they have some type of yield curve buying, so buying multiple maturities
Mm-hmm.
greater than a year, 2 year, 3 year, 5 year, 10 year, I believe the entire yield curve can be controlled that way. So more to come on that.
Yeah.
It's a topic we talk about behind the scenes quite often. So
Well, and the other side of the topic too that comes up on this conversation, Bob, is this going to mitigate the return and the risk in crypto going forward as it becomes more regulated?
um
Is this the beginning of it? Maybe
um
it's too early to be seen.
I don't know. This helps with adoption. This helps with taking the concept and making it more real.
Yeah.
That makes sense.
Yes. A lot of individual investors have viewed it as more of a speculative investment over the years.
Mhm.
Okay.
Yeah, well, it helps create more use value
Yeah.
for cryptocurrency.
Okay. Got it. Thank you.
Yeah.
The, the other conversation is the use of AI in creating a solution for our US fiscal problem, which so many investors have been concerned about for so long.
Yeah. So, the base case for artificial intelligence is it will help you,
Mhm.
not with one thing. It could help you with many things. It
Yeah.
could help you research rare diseases and come up with a cure. It can help you book vacations. It can help you write a paper. It can help you drive a car. There's so many potential use scenarios for artificial intelligence that it will no doubt provide assistance and efficiency going forward.
Hmm.
Make sense?
Yeah.
Okay. So this chart is fun because it is the CBO, which is the Congressional Budget Office, which is the group of people that have calculators and they forecast things into the future. But sometimes I think the calculators don't have batteries in them. In this case, I think they might have it right. They run this economic scenario where they're forecasting economic growth and federal debt as a percent of GDP in this country. And, they're usually always wrong to begin with um, because they don't factor in dynamic things. It's just fixed, forecasted. But here they are being dynamic and forecasting the benefits of artificial intelligence, both in the corporate world and in government. And shockingly, they come out with this illustration and say, yeah, actually, using AI, creating efficiency could cut a lot of waste and could help the economy grow more than it has for an extended amount of time, even in a scenario where we don't do anything to reduce our debt, we could just grow out of this scenario.
Correct.
Wow.
Yeah.
So I couldn't believe I was reading this. So we put it in here.
And I think what's so fascinating about this is obviously a concern that you and I have seen in our 30 plus career. It's never gone away.
Mhm.
And you listen to economists over time. Like I'll point out, for example, I've listened to David Kelly at JP Morgan for over 20 years talk about the fact that yes, you need to grow your way out of debt. You need to grow more than the debt is growing.
Mhm.
And this is the example that they're suggesting that is going to allow us to grow at a higher rate.
Yeah. Now, on the other side of the table, this is the CBO, so they could just be wrong again with their math. But conceptually, I actually agree with this.
It's a concept that has not been introduced until recently.
Right.
One last slide. This is our feel good slide, and we struggled with picking one out this month, but you found a good one.
I think it's a good one. So, thank you for listening to us and watching this video if you did, all four of you. Um, but if you did, shame on you because it's August and you should be spending your time having great experiences with people that you love. And from that, you will get a great feeling of happiness, right? So we just want to remind people that independently you can have memorable experiences and there are people that you love, but when you spend time with people that you love and like, there's a difference. And you overlay it with doing anything, it could create a memorable experience.
Mhm.
Um, and if you create those memorable experiences with people you love, it usually creates some source of happiness. So we have a happiness problem in this world, more specifically this country. So why don't you take the rest of the month of August and do what you're supposed to do, which is use your time wisely and go have memorable experiences with people you love. This way you're happy next time we talk to you.
Okay.
How about that one, Julina?
I love it.
Yeah.
And,
Yeah.
I got to point out with two teenage girls, if you've got loved ones that are in school, you got a couple weeks left. So
Running out of time.
get going.
Yeah. Yeah. Small pockets of happiness to be had.
Yeah.
Make sure you spend your time wisely.
Yeah, absolutely. I think it's a
Great.
great way to end. And I would hope that the listeners received the message today from us that, again, our tune hasn't changed. We've seen a little bit of a summer slowdown. I think we're going to see a little bit more of that too going forward, but that doesn't change our reason for optimism and more to come from the Fed in the fall. Anything else, Bob, that you want to end with?
No, it's a pretty solid foundation. The bull market continues, and we are about to get a whole bunch of tailwinds that are positive that will push us into a better place.
Yeah,
Stay
absolutely.
tuned.
No, thank you, Bob, as always. And as always, to the listeners, we appreciate your feedback. We appreciate your time and attention. And if there's any questions that we can answer here at Principal Wealth, please feel free to reach out to us.
Have a great summer and see you next month.
Next month, take care.